Hello and welcome back. It's not unusual to feel a bit uneasy about the state of the economy and the markets at the moment. Maybe you're a bit concerned that even though you understand that markets dip periodically, you're hearing phrases like this time is different, and that makes you more uncomfortable than you normally would be. So that's exactly what I wanted to talk about today, because every economic situation and previous crash has its own unique flavor. History doesn't quite repeat, but it has a way of rhyming. So let's consider this as we go through this video. So to help us with this, I wanted to have a quick look back at some of the most significant market crashes in history and understand what caused them, and see if those concerns are similar to what we have right now, and see if there's any new understanding we can draw from that. So by understanding the past a little bit better, we can hopefully navigate the present with a little bit more clarity and a bit less panic, and see if there may be a light at least at the end of the tunnel. So to really understand what's happening today, we need to take a more historic look. So why don't we rewind the clock and look at some of those major market downturns that took place in history. If we go back to one of the most eventful times in history, that was the Roaring Twenties. There was massive economic growth, new industries were blooming, and everyone seemed to be jumping onto the stock market, even borrowing money to buy shares, well, basically buying on the margin. But beneath the surface, there were a number of vulnerabilities, including overproduction through that industrialization and the raising and rising of tariffs as they choked off international trade. Now, that tariff point we'll come back to later on in the video. Then came October 1929, Black Thursday, Black Monday, Black Tuesday, days that saw the markets plummet and wipe out billions, and they ushered in the Great Depression. People lost their life savings, their businesses failed, and unemployment skyrocketed. It took about 2 decades for the market to fully recover. Now let's fast forward to the late 1990s and early 2000s. The internet was exploding. A new breed of tech companies, the Dotcoms, had emerged. Investors, fueled by the overhype and fear of missing out, poured money into often quite unproven companies, driving their valuations really high, often with little regard to the real fundamentals of those businesses. Well, many of those businesses lacked those solid foundations. In March 2000, the bubble burst and the Nasdaq crashed, losing nearly 80% of its value over the next couple of years. Trillions of dollars were lost, and many companies went bankrupt at that time. I remember this crash quite vividly, as I had at the time bought into the hype and invested in a company called Dotcom with a pretty big chunk of my savings. This was before I learned some of the basic tenets of investing. Then came 2008. This time the crisis originated in the housing market. Banks had been offering risky subprime mortgages, and these were bundled into quite complex financial products that were sold to investors worldwide. When housing prices started to fall, borrowers defaulted and the value of these securities plummeted. This led to credit freeze and the collapse of major financial institutions like Lehman Brothers. The crisis triggered a global recession with widespread job losses and significant decline in household wealth. I was working in the city at this point, and I remember well that many believed that this time was different around that period and that recession. So what do these crashes and other historical crashes tell us? Well, for one, they show us that market downturns, sometimes severe ones, are a recurring part of the economic cycle. They also show us that while the specific triggers might be different each time, whether it's excessive speculation or a housing bubble or something else, there are often underlying factors at play like overconfidence, easy credit, and sometimes policy missteps. So let's talk about the current situation. Today, it's the 3rd of April 2025. You've likely heard already about the newly implemented tariffs on imports from major US trading partners. These tariffs, which President Trump has called Liberation Day, are expected to increase prices. They're likely to slow down economic growth. We're already seeing a huge amount of market volatility, with some sectors like technology and growth stocks underperforming since he came into office. Consumers and business confidence has also declined, and many economists are even increasing their recession probabilities. And doesn't this sound a little bit familiar at least? Well, if you think back to the trade barriers that contributed to the Great Depression, while the specifics are different, of course, the potential for tariffs to disrupt trade, increase costs, and dampen economic activity is a real concern. The market's negative reaction to the tariff announcements echo how markets have historically responded to increased economic uncertainty. So there's nothing really new here. So is this time different? Well, the catalysts as broad-based tariffs is certainly a unique event in more recent history. However, underlying principles of economics, investor behavior remain still the same. Just like in the past, increased uncertainty and concerns about economic growth leads to market volatility. So again, nothing new in how the market is reacting this time. And so the crucial question, of course, is what can we do about it? Well, history offers some valuable lessons here too. Firstly, don't panic. Remember that markets each time recovered from those downturns. Selling in a panic can lock in losses. Secondly, stick to your long-term plans. If you've got a well-diversified portfolio aligned with your risk tolerance and long-term goals, try and resist the urge to make drastic changes based on short-term market fluctuations. Thirdly, consider dollar cost averaging or pound cost averaging. If you've got cash to invest, consider investing a fixed amount regularly. This can help you buy more when the prices are low and fewer shares when the prices are high. Fourthly, review your emergency fund. Having readily available cash can prevent you from having to sell investments at a loss during a downturn. And finally, seek reliable information. Focus on credible financial news and analysis and avoid getting caught up in fear-mongering and indeed over-optimistic predictions. Look, we know that market volatility is really unsettling, and that feeling that this time is different is a natural human response. But history does teach us that while the specifics change, the fundamental cycles of the market and the importance of a disciplined long-term approach remains constant. So what should we do? We should take a deep breath. This too shall pass. Use history as a guide, stick to your plan, and remember that even in challenging times, there are opportunities for those that remain calm and informed. Thank you for watching, and if you found this video helpful, please like and subscribe for more content like this. Let me know in the comments. I'd love to hear what your biggest concerns are in the current market and the volatility the market is bringing us. See you in the next video.